Well, good evening, everybody. We're still with a number of families to get on. They're signing in right now. So we're going to wait just a couple of more minutes before we get started. So I will be back. We're still having people signing in. So I'm going to give it about another minute and then we'll get started. So I'll be right back. All right. Well, we're still having people signing in, but I think we are going to go ahead and get started. And I want to welcome everybody that took the time out of your evening to be here tonight. Um, if everybody does get signed in, and most of you are, we're going to have about 250 people on this webinar tonight. So we are real happy with this great response. And you got to excuse me, this is talking all day and talking all night. But as I always say, this hoarseness goes away the more I talk. But, folks, a couple of things that we want to accomplish tonight. One is, there are many people right now just trying to understand, are we in a genuine bull market? Are we going to go into a hard landing, which basically means a more severe recession, which usually makes the stock market go down? Or are we going to have a soft landing, which means, maybe the Fed will just raise the interest rates just about right, and without really throwing the economy into a severe recession and give the room for the market to go up. So, what is going on, with the market? And so I want to start, folks, by sharing with you an abnormality in this market that is definitely showing something very unusual, and that is an extraordinary concentration of stock market strength in just a few stocks. So I want to show you exactly what I'm talking about. There are 7 what I call mega cap tech stocks that are all related to AI. And in case some of you don't know what AI is, that stands for artificial intelligence, where the robots are moving towards taking over the world, kind of like if you ever saw the movie The Planet of the Apes, where we'll be kind of like the slaves and the computers will be the bosses. I don't know if it's going to get that bad, but 7 stocks that are connected with artificial intelligence, as you can see on this chart. Now, this chart is ran through July 18th, so it's a couple of weeks old. But when you add take those 7 stocks out of the S&P 500 as of July 18th, it was only up 4%. In other words, when you look at all 500 stocks of the S&P 500 through July 18th, they were up 15%. But if you take out just 7 stocks out of 500, the remaining 493 stocks are only up 4%. In other words, just a little above flat. And folks, this is akin to a group of ants that are marching, but somehow get sidetracked by a piece of pie that they see in the grass. So the whole army of ants turns towards the pie except for the leading ant. And that leading ant keeps moving forward all alone. Okay, this is highly unusual and, in our opinion, somewhat dangerous because to be heavily invested in this market requires a disproportionate assumption of risk. If you're doing it without any exit strategy, which of course we do have, and we're going to talk about that. And by the way, folks, last year we were out of the market. We were not out of the market for the full year, but we were out of the market for most of the year, and we did far better than a traditional buy and hold model with the same amount in stock. And I'm going to talk about that more later tonight, but please note last year that we were behind, the buy and hold models a couple of times last year, but we ended up the year far better. Okay, on average, because we have people in more than one model. On average last year, we didn't get out at the perfect top. On average, we were probably down 13%. Some were down a little more, some less, depending on the model. But the buy and hold models with the same amount in stock were down anywhere from 17 to 24%. If they were overweighted in tech stocks, they were down 24%. Okay, so we ended up saving our clients anywhere from probably I would have to slowly think this out in my head, but anywhere from about 4 to about 10%, depending on what model they were in compared to the buy and hold crowd. But there were some times last year we were behind because we erred towards caution. And what you're seeing right here, folks, on that screen is a big concern of ours. Now, I want to share something else with you. All of this reminds me of some things that were happening in 1999 as companies rushed. This is 1999, folks, right before the dot-com crash that started in March of 2000. People rushed to jump into the internet boom that would change the world. And by golly, it did change the world. But what remains the same between then and now is that analysts, investors once again believe that trees can grow to the sky And the internet craze in 1999 sucked in retail as well as professionals alike. And Jim Cramer, we all probably know who Jim Cramer is, the kind of the TV stock personality, published his famous list of winners that for the upcoming decade in March of 2000. You want to see his list of winners? He published this list in March of 2000, folks. You can see the list right there. How many remember Ariba? Okay. Now, notice, folks, after he published his list, the 724 Solutions was down 99%. Ariba was down 74%. Digital Island down 94%. Exodus was down 100%. They went bankrupt. InfoSpace down 99%. Inktomi down 99%. Mercury Interactive down 55%. Sonora down 81%. And VeriSign was down 75%. I'm sure Mr. Cramer wished he would have never published that list. And folks, this wasn't surprising, as endless possibilities existed of how the internet would change our lives, the workplace, and our futures, just like artificial intelligence is probably going to do now. And while the internet did indeed change our world, the reality of overvaluation and earnings growth eventually collided with the fantasy, and the market just got clobbered. And I want to say this, folks, you know, there's so much I want to say and so little time to say it, but just to give you an example of two of those 7 stocks that are carrying the stock market this year, one of them is NVIDIA, and NVIDIA has a price to sales ratio of 38, which means, you know, for every dollar that you put in NVIDIA, you're getting 38, in other words, they divide the revenue or sales per share, you're getting $38 of sales or revenue for every $1 of as far as the price of NVIDIA. For every dollar you buy a NVIDIA stock, you're getting $38 of revenue. Okay, now, what does that really mean? Well, let me tell you a true story, folks. There was a guy named Scott McNealy who was the CEO of Sun Microsystems at the peak of the dot-com revolution in 1999. I just love this guy. And his stock was valued, it had a price to sales ratio of 1 to 10. Okay, now NVIDIA is 1 to 38. And this is what Scott Neely was quoted saying. He said at 10 times revenue or sales, to give you a 10-year payback, I have to pay you 100% of the revenue. In other words, all the money going through the cash register for 10 straight years as your dividend. Now he's speaking to stockholders. That assumes I can get that by my shareholders. It assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes zero expenses, which is really hard to do with 39,000 employees. That assumes I pay no taxes, which is very hard. And that assumes you pay no taxes on your dividends, which is kind of illegal. And that assumes with zero research and development for the next 10 years, I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at $64? Do you realize how ridiculous these basic assumptions are? This was Scott McNealy telling people how nuts they were to buy his stock for $64 a share, which gave him a price to sales ratio of 1 to 10. Well, NVIDIA is 1 to 38. It's unsustainable. Microsoft is 1 to 11. Even that's unsustainable. So, I mean, folks, again, if I get in all these financial statistics, I'm not going to get through this, but I want to show you something else that we are concerned about, and that's declining profits, better known as declining earnings, okay? So, as I've said, many of you know this, over the years, I have always said this because it's true. The number one thing that will drive a stock down is declining earnings. Now, let me give you a simple example, folks. Let's say my stock is trading for $100 a share, and it has $5 worth of earnings for each share. So I have $5 of earnings for my $100 share. So what you do, you take $100, which you put that in the top of the fraction. You take the $5 earnings, put that in the bottom of the fraction, and divide and come up with a ratio of 20. That's called the PE ratio. And that's one of the ratios that stock professionals use to determine if stocks are overpriced. Now, to give you an idea, the long-term PE ratio of the S&P 500 is around 16, okay, 16 and a half. So now, in my example, let's say that my earnings start declining. Now they're $5 a share, but because of hiking interest rates 11 times and the economy slowing down, my earnings per share dropped from $5 to $2.50, but the price is still at 100. We'll take $100 and divide it by $2.50, and guess what the ratio is now? 40. 40 is outrageously high. That means the stock is overpriced. So guess what? Sooner or later, the market's going to recognize that, and they're going to bring that $100 price down until it makes the PE ratio 20 again, which is more reasonable. And in my example, that would have to cut the stock in half. It'd have to drop to $50, because $50 divided by $2.50 gives me back my 20 as my PE ratio. Now, here's why I'm saying all this, folks. Look at this chart. Now, you can see, and this is pretty up to date, that the PE ratio of the top 10 stocks right now, you can see it up there. The top 10 biggest companies in the S&P 500 have a PE ratio of 29.3. Everybody sees that up there where my arrow is. Now, its longer term average of those top 10 stocks is 20.1. Okay, so you know what that means, folks? That means, and this is based on forward earnings estimates by stock analysts, which, by the way, we think are probably too high. So this is, you see, they can come up with what I call a PE ratio for the S&P 500. You just take the index today of the S&P 500 and divide it by the earnings for the S&P 500, which, by the way, right now are $232. And that gives you a PE ratio, okay? But here's what I'm saying, folks. Notice if their forward earnings estimates, in other words, this is where they're estimating the earnings to be over the next 12 months, $232 for the S&P 500. If that very rosy forward earnings estimate is correct, which we don't think it is, that means the current PE ratio is 29.3. That would make where the long-term average is 20.1. But what I'm getting at, if their forward earnings are correct, that means that stock is 45% higher than it should be. See, it says it's 145% above its average. Everybody see that? And if you believe their forward earnings estimates, and what I'm getting at, it means this stock could fall 31% to get back to its average PE ratio if their forward earnings estimates are correct. Okay, now if you look at the S&P 500 as a whole, all 500 stocks, you can see the current PE ratio based on their forward earnings is 19.1, and the long-term average is 16.5. Again, just simply pointing out that the stocks in the S&P 500, if these forward earnings are correct, is overpriced by about 16%. Now, let me show you something else here, folks, that we are concerned about. Okay, now, this next chart is simply showing that both the fourth quarter of 2022 and the first quarter of 2023, earnings were negative, trending down. But if you notice, folks, even before the earnings turned negative, they've been trending down. You see where my arrow, where that big long red arrow is? It's just showing earnings have been declining since early 2021, and they finally went negative in the fourth quarter of 2022. Then they went negative again in the first quarter of this year. And we don't have the earnings in yet for the second quarter. These are based on the 500 companies that make up the S&P 500, but with 80% of the companies reporting, FactSet, which is kind of the one of the most respected research firms that estimates these earnings, they estimate that the decline for the second quarter will be a negative 7.3, which, folks, in case you don't know, that's really bad. And that'll be the largest decline since the second quarter in 2020 during the COVID shutdown, where it had a record-breaking 32% decline. But you can't count that, folks, because, when you shut all the businesses down in the whole United States, of course you're going to have a monstrous decline in earnings. But if you throw that out, that second quarter during the COVID shutdown, this is the worst decline in earnings in over a decade, folks. What I'm telling you, 3 negative quarters of earnings is an ominous sign. And what I'm getting at for it, folks, if these earnings keep declining, the more overpriced this market is going to become, and the more likely it is that we're going to see it take a big hit. Okay, now, in case how many know what the word deja vu means? Well, I know it just means kind of we went through this before. Okay, history never exactly repeats itself, but those who ignore it are doomed to repeating it or coming close to repeating it. And in 2007, the final year leading up to the great market crash of 2008, second worst stock market crash in U.S. history, then is now the reassurances of a soft landing without a recession were everywhere. Now, you can see the quotes up here. I won't read all of them, but here in the Wall Street Journal, it says, jobs report is a perfect picture of a soft landing. And here is Bernanke. They quoted him in CBS News in March of 2007, no recession on the horizon line. And then, folks, you can see down here the Congressional Budget Office, and they quoted him in Reuters in January of 2008, no recession expected this year. Okay, folks, and they turned out to be spectacularly wrong. Could the warning flags and consumer debt credit situation that I'm about to show you turn into a non-event? Might our concern be overblown or misguided in contrast to all the major Wall Street firms that have a financial interest in making you believe stocks are going to keep going up? Could they be right? The short answer is yes. However, we prefer to err on the side of caution until stronger evidence supports a prolonged bull market. Now, we are in stock because our signals, I'm going to get to this later, did show that there was some underlying strength that it picked up. But I want to tell you, folks, and I said this when I sent out this letter with your performance report that I think most of you got, that these signals are on, our signals are on high alert to immediately reverse if the market starts to have meaningful deterioration, which is most buy and hold investors don't have that advantage, all right? So now I want to be fair, and I want to start by telling you the case for a soft landing, which might happen. By the way, I asked a client not too many days ago what he thought a soft landing meant. And he said, well, isn't that when you fall on your butt and you don't get hurt? And the answer is no, that's not what a soft landing is, folks. Economically, and I'm going to read you the definition, the goal of the Fed to raise interest rates just enough to stop the economy from overheating and experiencing high inflation without causing a severe downturn and possible stock market decline or a bear market. Okay, so that's a soft, so here's some things in favor of a soft landing. Now, the tight labor market has been considered a positive for the economy, actually for the last several years, and June's non-farm payrolls report showed 209,000 new jobs, another good month for this indicator. And you can kind of see this way over here on the end where my arrow is. And in addition, The unemployment rate is currently at 3.6%, just a little bit above its 50-year low. And with job growth holding up so well, it would seem to make a case for a soft landing. Now, here's something else, folks. This ISM service sector is something we look at every month. And basically, it is measuring whether or not the service industry is growing or contracting. Service industry and like restaurants, financial firms like ours, and things like that. So this ISM index remains in expansion territory, and you can see the recent reading of 53.9. Generally, whenever it's above 50, that means the service industry is expanding. When it's below 50, it means it's contracting. Now, it's not as high as it's been most of the time, but it is still in positive territory. And remember, folks, with service industry accounting for over 75% of gross domestic product, this current index level does show continued strength. And while there's no guarantee, its recent strength could provide hope for a soft landing. Okay, now here's something else, folks. One of the strongest supporters of a soft landing has been new home sales. Sales of new construction have rebounded sharply. It was in decline. You can, again, kind of see it at the end of this graph. And then it's been rebounding. Currently, they account for a near record 29% of all homes for sale right now are new homes that were just built. Whether this increase is sustainable will be more clear in the coming months. But again, it could be considered a positive for a soft landing. Now, here's something else, folks. With decreasing inflation comes decreasing inflation psychology. Recently, consumers have reduced their expectations of inflation over the next year significantly. So if you look at like this black line, that shows where the average consumer expects inflation to be over the next 12 months, 3.3%. And over the next 5 years, they expect it to be around 3%. And actual inflation is partially impacted by what consumers expect it to be. And it's possible that the expected inflation rate shown on this graph will continue its downtrend and make a case for a soft landing. Okay, now the consumer price index is leading the optimistic charge in the media with reports of decreasing inflation over the last 12 months. Most of you probably know the current reading of the consumer price index, you can see it on my graph, is 3%. So it fell from 4% to 3% in June on a year-over-year basis. While much of this decline, by the way, was driven by cyclical factors that could change overnight, like energy costs, it still makes the case for a soft landing. Okay, so now, folks, hang on to your seats, because now I'm going to make the case for a hard landing. So a hard landing means we go into a severe recession, unemployment goes up, and people start getting laid off, and very likely we're going to see a decline in the stock market, which in our view could be pretty bad. Again, I don't have a crystal ball. I always say if I had one, I wouldn't use it. But let me show you some reasons why we're still on high alert, folks. But before I get to that, I want to remind you of something. I said this in the January webinar, and I want to say it again. If we are headed for a hard landing, remember, which means we're going to have a recession. Bear markets that are accompanied by recessions go much deeper. That means they go down more and they last a lot longer. Okay, and to give you an example, if we take the last 3 recessionary bear markets, which would be the dot-com crash, the 08 crash, and the COVID crash, that they averaged a 46.7% decline in the S&P 500 when it got to its lowest bottom. Okay, so if that average holds up from where we're at today, this market could go down another 35 or 40%. Now, am I saying it's going to do that? What I'm saying is I don't know, but we're still on high alert. And by the way, some people have asked, aren't we already in a bull market? Actually, the market hasn't even recovered from its high yet, folks, where it was at in January of 2022. But I want to show you something, folks. Now, over the past 100 years, there have been a dozen bear market rallies of 20%. That means where the market rebounded 20%, and everybody's going, it's over. And the market wasn't done crashing yet. So we've had about a dozen of these over the last 20 years. And not surprisingly, 5 of them were during the infamous 1929 to 1930 crash during the Great Depression. And you can see them if you look over my first chart on the left. Here, the market rebounded 29% to that green dot, boom, went down again, rebounded again 29%, boom, went down to the red dot, rebounded 26%, rebounded 27%, rebounded 31%. Now, there were other rebounds, folks, but I'm just showing you the 5 where it rebounded above 20%, which is considered what they call a bear market rally. Okay, and a not so humorous anecdote about this, 7 months after the 1929 crash, President Herbert Hoover, when the market rebounded this second time, you see where my arrow is over there on the left, folks, the second time it rebounded 29%. This is what Herbert Hoover said on May 1st of 1930. He says, while the crash only took place 6 months ago, I am convinced we have now passed the worst, and with continued unity of effort, we shall rapidly recover. Sadly, the majority of the 1929 bear market still lay ahead. And likewise, folks, in the 2002 dot-com bear market, it was interrupted by 2 very alluring back-to-back bear market rallies that technically, by Wall Street standards, would have qualified for new bull market status. And you can see them there in my middle graph. One ran up 21%, one ran up 21%, and the market was not done crashing. Okay, so I'm just making the point. Sometimes the market can have a nice rally, especially when it's being assisted by all the what I call artificial intelligence craze to just frankly unsustainable levels, only to turn and go down again. Okay, now I want to show you something else, folks. This again is in the case of a what we call hard landing, and that is some of the inflation indexes that the Fed is watching, much more than headline CPI, are still too high. Now let me show you an example. A more important inflation indicator is the core personal consumption expenditures price index, which measures what I call PCE, personal consumption expenditures, excluding food and energy, which tend to be volatile. The CPI index that you always hear about in the headlines, it does include food and energy. This one doesn't. Okay. This is the Fed's preferred measure of inflation. And look at it, folks. You can see it remains more than twice the 2% inflation target. It's currently at 4.6. Now, making the situation even worse is that core PCE, which is what you're looking at, has been flat for the past year. If you look at the little inset graph, that little inset box, it's just been flat and refuses to fall. In other words, it refuses to go down. And even if it does start to trend lower, which it hasn't yet, it'll take quite a long time to reach the target level goal of 2%, which will put pressure on the Fed to keep interest rates high for longer. Now, I want to show you another inflation index that the Fed is watching, and this is called the sticky price CPI. Okay, sticky inflation tracks items that change in price very slowly. And what am I talking about? Wages is an example. Once you give somebody a pay increase, it's pretty hard to take it back just because inflation starts going down. Rent is another one. Once you raise the rent, it tends to stay elevated. And certain kinds of medical expenses and some other things. But here's the point, folks. Sticky price inflation has not come down as rapidly as overall measures, and sticky price inflation, while it has started to come down a little bit, it still is quite elevated with a current reading of 5.8%. This does not make a case for the Fed starting to cut rates or even stop raising them. So we think it's possible they could raise them once or twice more. Okay, now I want to point something else out, folks. When you have rate hikes, historically, it does lead to a recession. And what you're looking at there is the history of what's happened since March of last year. The Fed has now hiked rates 11 times. You can see it right here. And I want to say this, I said it in January, but it deserves repeating again, and that is since 1965, every time the Fed has raised interest rates this fast, this many times, it has 100% of the time led to a recession and a market drop after the last rate hike. Now, could this be different? Of course. But I am just telling you, folks, there is, as one of our research partners pointed out, every time the Fed hikes rates this much, something is going to break. Okay. I haven't even talked about the credit card interest rates right now, which are at the highest level in the history of the United States. Hang on, it's coming, folks. But first of all, I want to show you something that nobody is talking about, and that is called shrinking money supply. And I want to show you one recessionary red flag, and I'm going to try not to get in weeds too much on this, folks, but this is M2 money supply, which actually just went negative in the last several months. But what is M2 money supply? Somebody goes, oh, Mike, you're bringing back nightmares from my economics class in college. I thought I didn't have to learn that stuff anymore. But here's what M2 money supply is, folks. It's cash, personal savings, money market accounts. In other words, money that's accessible to consumers. It's basically cash, right? So they call that M2 money supply, and it fell to little under 21 trillion in April, a drop of over $1 trillion from a peak in July of 2022. On a year-over-year basis, this 4.6% drop in April of 2023 is the largest decline since the Fed began formally tracking M2 money supply in 1959. And I'm sorry, I said a negative 4.6, it's negative 4.1. And by the way, folks, it's believed to be the biggest drop in M2 money supply since the Great Depression, even though they only been formally tracking it since 1959. M2 money supply fall is being driven not only by the Fed shrinking its balance sheet, that's called quantitative easing, which I'll talk about in a moment. More economics coming, folks. The higher interest rates have motivated people that have their money in checking accounts and savings accounts to move billions of dollars from these cash accounts over to bank CDs with maturity dates to get a better rate of interest. And that's pulled a lot of money out of cash position, which is what M2 money supply is all about. Now, folks, the decline in M2 could lead to what is called deflation. Historically, that's what it does. Now, let me tell you this, folks. You hear the term disinflation, which is what we've been experiencing the last year, and deflation. What's the difference? Disinflation, which is what we've been experiencing, is the rate of inflation climbing slower. So inflation is still going up, it's just not going up as much. So like remember last year it got up to 9.1, then it declined several times. And the most, in May it was declined to 4%. So it was still increasing 4%, but just not as fast as it was before. Then last month it went to 3%, which means inflation is still going up, but at a slower pace. That's why those bags of potato chips still seem outrageously expensive. That's why those Hershey bars are still like unbelievable for a Hershey bar. I never shop, but I went in the store the other day with my wife. I hadn't been in for several months, I'm embarrassed to tell you, and I wanted to buy a candy bar. And when I saw what it was, I called the lady over. I was doing the self-checkout, and I said, hey, I said, I don't want to buy this candy bar if it's $1.50. I said, that's crazy. And she said, sir, I can tell you haven't been in the grocery store for a while. But anyway, so we did buy, because if you bought 3 of them, you got it for half price. So I relented. But my point is, folks, prices are still going up, but just at a slower pace. But deflation is where prices start falling. You say, well, man, that sounds great. Let them fall. But here's the problem with it, folks. You see, if you get into deflation, which M2 declining like this, it could be the beginning of that. Then, if it goes below zero, which, would be the last time, prices went below zero was during the Great Recession of 08. But deflation can actually cause a depression, and historically can cause panics, because it can really throw the economy into where it just causes businesses to do terrible. And again, I just don't want to get on a rabbit trail on M2, but I just want you to be aware. You heard it here, folks. You heard it here first, folks, that declines in M2, as the U.S. is seeing now, have been correlated with economic depressions and panics, according to this gentleman named Anastasiou, who's with Economics Uncovered. He's a very respected economist. And the last time it happened was during the Great Recession from December of 07 to June of 09. So it's something we're watching. Now, I want to show you something else, folks, that is connected to this decline in M2 money supply, and that's the Fed shrinking their balance sheet. And you can see that they did reduce it from April of 2022 through today. They've reduced the Fed balance sheet by $691 billion. So what does this really mean, folks? When the Fed shrinks its balance sheet, it is known as quantitative tightening. Remember quantitative easing, where they were expanding their balance sheet. In other words, what they were doing is printing money, using it to buy bonds with this printed money. So what would happen? The bonds would end up on the balance sheet of the Fed, and then the money would end up in member banks, and it just caused the money supply to expand. Well, now they're trying to cause the money supply to contract. Okay, and why are they doing that? Because it is a way to slow down the economy. When you have less money in the economy, it's like having less of anything. You go to Walmart, you got less of some item sitting on the shelf in Walmart. It makes the price go up because you got less of it, right? Well, when you have less money floating in the system, it causes money to get more expensive, and the cost of money is interest. So it's another kind of a backup measure the Fed's taking to cause interest rates to go up. Not maybe the Fed funds rate, but other interest rates to go up as a way to slow down the economy. Okay. So, and that's called quantitative tightening, where they suck money out of the U.S. economy, again, as a way to increase demand for money, which tends to raise rates to help kill inflation and slow down the economy. They do this by either selling bonds that they're holding in exchange for cash. So the bond goes out to the member bank that bought it, and then they take the cash out of the economy. Or they just wait for the bonds to mature and not renew them and just let the money run off, instead of putting it back in the economy. This definitely has been a major factor in shrinking M2 money supply. And there's concern they may be going too far and causing us over the next few months to go into not disinflation, but deflation, which can be a more serious thing. Now, here's something else, folks. Another indicator that is screaming hard landing is the Federal Reserve's yield spread model, which measures the risk of a recession in the next 12 months. It's based on the difference between the long-term and short-term Treasury bond yields. As most of you know, the shorter-term bonds have got a better interest rate right now than the longer-term bonds. But here's the bottom line. This Fed yield spread model, which again is measuring the probability of a recession in the next 12 months, recently hit a 42-year high of 71%, which means right now, that means there is a 71% probability of a recession in the next 12 months. Now, folks, here's the thing to remember. This highly dependable indicator has never in its history reached this level without a resulting recession. You can kind of see the recessions, those vertical gray bars, as going all the way back to 1959. It has never reached this level without a recession. Okay, now here's something else, folks. I've mentioned this in my letters. I mentioned this in January, but the Conference Board's leading economic index is published monthly and is one of the most important and widely recognized leading indicators of the U.S. economy. Leading indicator, in other words, it predicts it before it happens. Okay, the LEI index is a composite index made up of 10 components that includes looking at employment, manufacturing, housing, consumer sentiment, stock prices, credit, etc. Right now, it's the most glaring evidence against a soft landing. The LEI index has fallen for 15 consecutive months. Declines of this magnitude have always corresponded to a hard landing. And also, when the LEI index falls below its 18-month moving average, and you can see it has, look at the very end of the graph, folks, the red line is the 18-month moving average, the black line is the LEI index, and you can see it's fallen well below its 18-month moving average. A recession almost always invariably follows. Okay, so I'm just showing this stuff to you. Now, something else, folks, that could be the biggest underestimated systemic risk right now today is the housing market. And a stunning statistic is that the U.S. population, excuse me, folks, I got to have a drink of my water. The U.S. population is 19% higher than where it was in January of 2000. Okay, it's 19% higher, while the inventory of existing homes for sale in the U.S. since the year 2000 is 37% lower. Okay, so in other words, we got a lot more people and a lot less existing homes for sale. So what has this done? It's led to two things. The first thing is the median price of an existing home sold in the United States is up 14% just from its low in January of this year, and is now close to its all-time high ever in history, which was in June of 2022. It's almost back up there again. In other words, demand for existing homes is up dramatically. And you know why, folks? There's no supply. If you ever wanted to sell your home, the time is now. But then, as somebody said to me, yeah, Mike, but then I got to buy a home and there's no supply. And that's a good point. Okay, but you know, you can get a good price on a home right now. Now, here's that's one thing that this has led to. Again, low supply, higher population is just caused these home prices to skyrocket. But here's a second thing this has caused, folks. Due to the extremely low levels of inventory of existing single-family homes, in other words, it's led to new homes representing a much larger share of overall supply. In other words, right now, the reason there's so many new homes being bought is because nobody can find an existing home to buy. And the new homes, as most of you know, cost a lot more money. It costs a lot more money to build a home right now than to buy an existing home. So in other words, part of the concern is if we go into an economic slowdown and people start getting laid off, there could be a lot more foreclosures since people are paying much higher prices for these homes. Okay, that's one big concern. Now, here's something else, folks. You know, the Green Street Commercial Property Price Index, which is another index we track, is based on estimates of price appreciation of portfolios owned by a selection of U.S. real estate investment trusts. Some of you know those are just, they're almost traded like stocks, you know, but where they go out and buy just a lot of different properties. But this index encompasses 15 different property sectors, ranging from things like office and retail to others kinds of real estate like healthcare, industrial, and student housing. And many of these sectors, as some of you know, have been in a state of turmoil this year, especially in retail and office. Folks, you want me to show you something? I did this just for you. Here's the Wall Street Journal, and this is August 1st. This was Tuesday of this week. And you see, I've had people say, Mike, your TV skills are terrible. I know that. I've never, but see, folks, I don't know if this is showing frontwards or backwards to you, but you see that headline I circled in orange. This is what it says. I don't know if you're reading it backwards or forwards, but it says, this is Tuesday of this week. Shopping malls face default fire sales as valuations plunge. This is going on all over the place, folks, because here's what my point is. This index, you can see where my red arrow is now lower than pre-pandemic levels and has reached its lowest level since 2018. And while real estate risks are broader than many realize, we believe one of the biggest risks in real estate lies with commercial real estate debt. Okay. And folks, remember this. Commercial real estate landlords currently own over $1.5 trillion in debt that's going to mature over the next 3 years. A lot of it's starting to mature now because commercial real estate, as some of you know that have it, can't get a 15 or 20-year mortgage. Most of their mortgages only last 3 to 5 years. So they're starting to mature now. Okay, and guess what's happening? When they go to renew the mortgages, their mortgage payments are becoming astronomical because of the way the interest rates went up. And folks, listen to this. The vast majority of commercial real estate loans are structured as interest-only loans where the principal of the loan does not decrease as the payments are made. Many commercial real estate debt holders may not be able to sell their properties at high enough of a price or refinance at a lower enough interest rate to get out of the hot water, you see, because they may not be able to afford to make the payments and they may not be able to sell to get all their money back because of the way the prices are starting to decline. So this is something that, again, folks, I talked about it in a newsletter earlier this year. I'm bringing it up again, but these chickens are starting to come home to roost. Now, some have made the case that today we don't have the subprime mortgage crisis that triggered or precipitated the 2008-2009 recession and housing debacle. But there's a few things that I want to point out from this overlay of the current housing market with the previous housing bubble of almost 20 years ago. Now, folks, listen to this. Since early 2019, the run-up in other words, it's the black line. Look at the black line. The run-up in housing prices this time was even steeper than the 2002-2005 run-up, and has created an even greater affordability problem because these houses are so high. Housing prices on average have peaked about a year ago and are now declining a little bit. You can see from the peak how they started. You see, look at the top of the black line. You can see they started declining a little bit. in some areas of the country. I'm not so sure it's been around here yet, but it is still very early in the unwinding of today's potential housing bubble. But when compared with the delayed impact of the slipping home prices and the 06-07 housing bubble bursting that eventually exposed the subprime mortgage risk, this suggests the next 12 to 18 months could be very revealing, folks, because again, well, I know we don't have a subprime mortgage crisis. I'm not talking about that. But as housing prices could start declining even faster if we go into a recession, which again could exacerbate this whole thing going on in the economy. So it's just something we want you to be aware of. We think it is possible. We are in a housing bubble, both in single family homes being elevated to these high levels and commercial real estate. Okay, another systemic risk that threatens. Okay, does everybody want to take a 1 minute break and you're saying, give me something to drink? No, I'm just kidding. No, don't. I'm sorry. I mean, it's up to you if you want to take a break, but I'm taking a 20-second break. Maybe it'll be less than that, but okay. By the way, people say, Mike, what's in that bottle? This is actually alkaline water, which is good for you. Okay. Another systemic risk that threatens to derail today's economy, folks, is consumer debt. Now, I want to show you something here. In some households, consumers took on more debt than ever after the pandemic, and this was partly due to decades high inflation. Okay, as a result, the combination of auto loans, credit card debt, student loans, and other debt is now at a record high. Folks, when I say a record high, it's the highest level of consumer debt in the history of the United States. It's over $4.5 trillion now. And it's 72% higher. You can see my red arrow than it was during the great financial crisis. So we've got these really elevated levels of consumer debt right now that could become more unsustainable over time because, the interest on this debt has just gone up so much. Okay, now here's something else I want to show you. Those who have opened new credit cards in recent years or who regularly carry credit card debt are quickly coming under severe financial stress. Monetary tightening, which means the Fed hiking interest rates, has driven average credit card interest rates to over 22% in May. That was the highest rate since the Federal Reserve started tracking the data in 1994. In other words, folks, these are the highest average credit card interest rates in history. Extremely high credit card interest rates combined with record consumer debt outstanding could prove to be an ominous combination. Remember this, folks. Consumer spending is the ultimate driver of the economy, making up almost 70% of GDP, gross domestic product. And if consumers can no longer afford to spend, then this systemic risk becomes a real problem. Okay. And also, folks, going right along with this, consumers amassed over $2 trillion in excess savings during the pandemic, primarily due to government support and lockdowns. Remember when the government was paying everybody to stay home and not work? And then because everything was locked down, the money they paid them, they didn't have anywhere to spend it. And after the lockdowns ended, consumers spent as if they had unlimited funds. Tack on decades high inflation, and they've now burned through 80% of that excess savings, folks. Based on current trends, these savings will be completely exhausted by the end of this year. And once the savings is depleted, consumers will likely resort to more of this very expensive revolving credit, and which could cause record-breaking consumer debt to go even higher. Okay. Now, folks, The other thing I want to do, and I know I talked to you about some of you on about some of this one-on-one. Some of this I brought up in January, and it just bears repeating. But many believe that because of inflation coming down, that means that we don't have to worry about stocks going down more. Okay, but I want to show you something. During the dot-com crash, inflation peaked in June of 2000, with the eventual bear market bottom ending October 9th of 2002, over 2 years after inflation peaked. Now, inflation peaked late last year. Remember, it peaked at 9% and now started declining. But again, so people have this attitude, hey, man, there's no way stocks can go down with disinflation, the rate of inflation going down. Well, it sure didn't work out that way in the dot-com crash. The market finally hit its lowest bottom 2 years after inflation peaked, down 46.15% from the inflation peak. Now look at the second bullet point. During the great financial crisis bear market of 08, inflation peaked in July of 08, and then after that, the rate of inflation started going down, but the eventual bottom of that bear market was March 9th of 09, down 46.6% from where inflation peaked. So folks, I'm saying just because the rate of inflation is going down doesn't mean we're out of the woods as far as the market declining further. The other thing I want to point out, again, I know I showed this to some of you before, but many people think as soon as the Fed is done hiking rates, the market's going to take off. Well, I want to show you a little history of what the stock market did after the final rate hike, which I'm not sure we've had the final rate hike, because inflation, as I showed you, some of the more preferred inflation measures like core PCE is still almost 5%. But let's say it is the last rate hike. If you notice, if you look to the left, this column shows all the way back to 1929, the final rate hike date, and then it shows in the second column the total number of rate hikes during that cycle. And then the third column shows you if there was a market crash after the final rate hike. Look at all those yeses, folks. The vast majority of the time after the final rate hike, there was a market crash. No, of course, this one is terrible, but it is what it is, folks. Look at the first one. Was 1929. The final rate hike was August 9th of 1929. They did 4 rate hikes. Was there a bear market? Yes. The maximum loss following the final rate hike, negative 84.5%. Now, you can kind of scan down there and see how bad, some of them weren't as bad as others after the final rate hike. But recently, like in the dot-com crash and the 08 crash, certainly we had a huge market drop after the final rate hike. So I just wanted to point that out. When the Fed finally does stop hiking rates, or if they did, doesn't mean we're necessarily out of the woods as far as the stock market going down. Also, folks, something else I want to point out to you again, I know I said this before, and I'm going to say this again. Low unemployment does not mean that there's not going to be a recession. Because here's what some people are saying. They're saying, how could we possibly be in or near a recession with unemployment at 3.6, which is near a record low in the last 50 years? Well, let's look at the last 3 recessions and look at unemployment at the start of the recession. Okay, so here's the first example, folks. During the dot-com recession, that was a really bad market crash, by the way, but during that dot-com recession, it officially started in March of 2001. So the last unemployment reading before it started, which would have been the month before, in other words, February of 01, unemployment was 4.2% in February of 01. Then the next month, recession started. Okay, by the end of the recession, in November of 01, the unemployment had climbed to 5.5. Okay, so unemployment climbed after the recession started. Now, the great financial crisis recession of '08 the recession in '08 started in December of '07. So the last unemployment reading the month before the recession started, which would have been November of '07, unemployment was 4.7%. By the end of the recession, in June of '09, unemployment had climbed to 9.5% after the recession started. In other words, the unemployment doubled. Now, I want to give you one more, folks. The COVID recession officially started in February of 2020. So the month before it started, which would have been January of 2020, unemployment was at 3.5%. Okay, by the end of the recession, in April of 2020, unemployment had climbed all the way to 14.7%. Whoa. So, folks, what does this tell us? Unemployment does not rise before a recession, but instead it rises during a recession. As such, unemployment has very little value as a leading indicator of whether or not we're heading into a recession. Okay, I just want to make that clear. Now, I put another chart in here, folks, that, we just mailed out your performance report, and I put that chart. I always put in a cover letter. I do write these letters myself, by the way, and I put that chart in there, and I actually had somebody send me an email. You know who you are, Bill, hi. And Bill said, Mike, what does that chart mean? Would you explain it? So yeah, I put in that chart, Bill, for you, but not really just for Bill, but kind of I did. But I decided to put it in because it's a great chart anyway. Okay, see, folks, let me say this before I show the chart. There are a number of reasons why we believe the bear market may not yet be over. Okay, confirming evidence of a new bull market has never been this weak, in my experience. Warning flags of a recession and a bear market are still present, and some of these warning flags are increasing. The Federal Reserve Board's monetary battle, in other words, hiking rates, is most likely not over, where inflation still is, especially core PCE inflation, which is the one they really look at. And while we're not always right, we have consistently erred on the side of caution. And sometimes we've gotten in the market a little late, but folks, the reason why, and I'm going to show you something about that in a minute, but we have consistently erred on the side of caution, which has allowed us to emerge on the other side in better shape with our portfolios intact. It doesn't always happen overnight, okay? And a new board, and here's the other thing I'm going to say. If this is indeed a new bull this late at night, I just can't talk. No, if this is indeed a new bull market, it is undoubtedly one of the most unusual in Wall Street history. I already showed you at the beginning of this webinar how only 7 stocks connected to artificial intelligence have carried most of this market up. Folks, that is not the kind of stock market we want to see. It needs to have more breadth. In other words, more of the stocks participating, which some of them did start increasing in strength, but not like those 7 AI-related companies that I showed you, okay? But here's another example of why, if this is a new bull market, it is indeed one of the most unusual in history. And that is this slide right here. So here you go, Bill. Now, so a prime example of this incredibly uncommon bull market is evident in the comparison of paths that the Russell 2000 index usually takes after it hits a market bottom. So folks, let me show you how to read this. Do you see all these dates over on the right? It says 1987, 1990, 2002, forget average path for a minute, 1982, I'm not sure why they took that out of sequence, 2009, 2020. Okay, what they're showing you is that all the times the Russell 2000, which is a stock market index made up of 2,000 small cap stocks, and by the way, folks, when you hit a market bottom, a real market bottom, the small caps tend to go like this. Zoom, they take off. In other words, small cap stocks tend to go up a lot faster off of the when you finally hit the lowest market bottom than large cap stocks. So all this chart is showing, it showed all these different dates like 1987, 1999, 2002, 1982, 2009, 2020. They're showing you, see that red dot down there in the middle of the bottom? That's where the Russell 2000 hit the lowest bottom in that stock market crash in all those different crashes. And then it's showing you how much it rose. Okay, and now you see where that dark black line where it says average path, everybody see where it says average path? That's showing you the average, steep rise that the Russell 2000 is averaged over all those, jumps from the bottom. Okay, so what I'm saying is this, folks. Usually, the Russell 2000 or small caps typically lead with some of the sharpest and largest gains in the first year of a new bull market. But today, the small cap Russell 2000 is a fraction of what it should be 8 months into a new bull market. Look on the very bottom. See where my arrow is twirling there, folks? And it says current path. It's just kind of crawling along the bottom. I mean, going up a little, down a little, but that's not what it historically does. Small caps, when you're at a real market bottom, have some of the, again, folks, the sharpest and largest gains in the first year of a real bull market. As the old saying goes, it's not happening. Okay, now, folks, I want to share with you what we see going on and where our opportunity for you lies this year. Okay, and I want to mention two opportunities. Okay, one of them is in the bond market. Now, I want to share something with you, folks. I know some of you know this. I've shared with some of you individually. I even mentioned it in January when we did our webinar. But what you're looking at is a chart going all the way back to 1928, showing you what the return was every year for the 10-year Treasury bond through 2022. Now, of course, 2023 is not over yet, okay? So I just put the 1928 to 2022 because we know what those years did, okay? 2023, we won't know till December 31st. Now, where the box is green is showing you, where they made money, and where the box is pink, it's showing you where they lost money, okay? And by the way, I don't mind telling you for 2023, it's flat. It hasn't made anything yet. But again, okay, so where the box is green, it's showing you, where they made money, where it's pink is showing you where they lost money. Now look at 2022, folks. See the pink box down there? Look, you see how much money the 10-year Treasury bond lost last year? 17.8% negative. Folks, in case you didn't notice, it was the worst decline in a 10-year Treasury bond in U.S. history. Look at the chart, you won't see any year that's even close to how bad it went down last year. Now, what in the world caused that? What caused it was the Fed hiked interest rates. Not only did they hike them 7 times last year, they did it at the fastest pace in history. They even broke Volcker's record under Ronald Reagan. And of course, then they hiked them 3 more times this year. And you know how it goes, interest rates go up, bond prices go down. But when you hike them that aggressively, it clobbered bonds, okay? And folks, listen to this. Our bond signal triggered a buy to get out of bonds in January of last year. It wasn't perfect, and the bond market had already gone down before we got out, but we ended up in a lot better shape than the buy and hold people did. Okay, now, here's why I'm showing you this, folks. Now, historically, if this market does decline more, okay, bonds tend to do very well in years where the market is going down. Now, let me show you an example. I don't know if you know this or not. Most of you probably do. Look at 2000, the year 2000. Okay, 2000, 2001, and 2002, the S&P 500 lost money all 3 years. I think in 2000, it was down over 16%. 2001, it was down I'd have to look. I can't remember. I know all 3 years it got slaughtered. Okay, because that was the dot-com crash. The S&P lost almost 50% over those 3 years. Now look at what the bonds did. In 2000, see that? The 10-year treasury went up 16.7. That's what they do usually most of the time when stocks go down. 2001, they went up 5.6. 2002, they went up 15.1. Now, folks, look at 2008 up here. Now, in 2008, I do remember for the calendar year, the S&P 500 was down. Now, wait, do I remember? Oh, the S&P was down about 36% for the calendar year. Now, it really was down 57%, but for calendar year 2008, I think it was down about 36%. Look at the bonds, folks. They went up 20.1. Now, here's why I'm sharing this with you. We see an opportunity this year on the bond side, and our signal, I keep saying it's about to go positive, and it just hasn't, folks. In fact, thank goodness we didn't go back into the bonds. Right now, to give you an example, the AGG, which is the Barclays Aggregate Bond Index, for the year is actually negative as we speak. In other words, bonds just have not done anything. But folks, I am telling you, our bond signal is going to go off sometime, I believe in the next few weeks, and we see the opportunity on the bond side for double-digit returns this year. Now, that's one thing I wanted to point out to you. And sometimes you just got to wait for the opportunity. One of the things that's been holding bonds down this year is the Fed hiking the rates like they have. But, folks, remember, bonds only go down so far, and then they'll stop going down because they have a maturity date. And the bondholder knows if he just holds it till maturity, he's going to get all his money back, and that tends to act like an anchor for the bonds. Now, here's something else, folks, that I wanted to point out to you before I end our workshop. I know some are going, "Oh, Mike, please go on. No, I know. Folks, listen, I've been have people tell me for a year, gee, that guy does long workshops. How does he talk that long?" But folks, I'm an ex-school teacher, and I tend to, you wouldn't believe how many slides I cut out tonight. There's so many things I want to tell you, but I just don't want to keep you here all night. But I want to say this, folks. The second opportunity we do see is on the stock side. Now, just so you know, and I explained some of this in this letter, that in the last 2 or 3 months, our own buy-sell signals registered enough solid strength that we started moving money into stocks. We did it over a period of a few weeks, but at the same time, these same 3 signals that registered some strength in the market are still on high alert. And in other words, they're on high alert to immediately reverse if the market starts to have meaningful deterioration, which is something that people that don't have a system like ours don't have that advantage. But here's why I'm saying this, folks. I think it is very possible this market decline isn't over. Yes, we have some money in the market right now. We don't have the most we could have in, but we did put some in. But we are on high alert. And while we are in there trying to pick up some of this market, what we're a lot more concerned about, it's not making, riding the market as high as we can like the buy and hold crowd does, but picking up some while we're waiting for the main opportunity. Folks, this is not the main opportunity. This is all the buy and hold people got to hope for, is that the market keeps climbing. These 7 artificial intelligence related stocks are going to keep dragging this market up. Oh, please, please let this market keep going up. And if it suddenly gets blasted again, they're just going to go down a lot more than we're going to go down. I'm just telling you this, folks. But what I'm saying is, what I see a very likely scenario, things in a few weeks, maybe it could be a couple of months, I think quite possibly could deteriorate again, because sometimes when the Fed hikes interest rates like this, there is a delayed reaction before everything starts hitting the fan. I showed you a lot of things that we see about to hit the fan. If that does occur, we may not get out at the perfect high, but trust me, we will get out and we'll be in good shape when we do. And folks, then the real opportunity is when we get to the bottom of this bear market. And let's say we're wrong and the market keeps going up. Then eventually, and it may be a few weeks, our signals will catch it, and then we'll go on what I call we call this putting the pedal to the metal, and we'll increase the stock levels above their normal amount, depending on what model you're in, but we'll drop the bonds and go all stock, folks, like, how our system works. But our system is warning us not to do that right now. And then, so if we're wrong, we have ways to catch up. But folks, I'm just telling you, don't make the mistake of saying, oh, why didn't you go in at the perfect day the market took off? It doesn't work that way, folks. In fact, one of the slides I took out tonight, because I just didn't want to keep you here all night, but I have a slide that I just updated, and I just took one of our more popular models that had 60% stock and 40% bonds, and I went all the way back to January 1st of 2021, or I'm sorry, 2001. So in other words, I went back 22 and a half years and broke it into quarters. So I looked at and what I was doing was comparing one of our most popular models that many of you are in with a traditional buy and hold model with the same amount of stock. They both had 60% stock and 40% bonds. And that traditional buy and hold model, by the way, I thought I had it laying right here. Where is it? I know. Say, this is the disadvantage of being in my office. I can grab things. The model I compared this to is right there, folks. It's a Morningstar recommended buy and hold model, professionally diversified. They both have 60% stock and 40% bonds. Now, where am I going with all of this? I went back every quarter, 22 and a half years. And here's what I discovered. With that particular model, 40% of the quarters, the buy and hold model beat our model. And in 60% of the quarters, we beat the buy and hold model. And yet over that 22 and a half year period, we made 4 times as much money as the buy and hold model. But sometimes we lag because we err towards caution. So even though in 40% of those quarters, the buy and hold model beat us, we ended up making 4 times as much money over that 22 and a half year period. So what's the moral of the story, folks? You ever heard the old saying, you can miss the forest for looking at the trees? Folks, I am just telling you, you got to understand this is an alternative model. And you know what it does, that a buy and hold model does? And it doesn't do it perfectly, but it'll show you when it's time to reduce stock. And also it'll show you when it's time to increase stock above normal levels. And if somebody can show you how to do that with a reasonable amount of accuracy, it's worth its weight in gold. But you don't always see it if you are just looking at a few weeks or even a couple of months. You're just not going to tell anything. Okay. So you got to let us, and I'm saying this mainly for some of the new people. And frankly, I mean, most of you have been perfectly happy. You haven't, but I'm just saying this, just as a way to encourage our newer people that may have only been with us a few months, that's our system is number one, protecting you from catastrophic drops. Okay. So that's our number one goal. But by strategically reducing stock when the risk is elevated according to our 3 signals, and at other times increasing stock above normal levels when we can show the risk is low, it doesn't work 100%, folks, but it works good enough where we end up protecting the downside a lot more and getting historically better returns. Okay, so guess what? I'm out of time. And, and by the way, folks, I will be talking more about this. I didn't want to, this webinar tonight was not to talk about us joining our new company, Apollon. I will tell you, as I said before, your fees stay the same. I'm still here. All the staff is here. we're still called PeerShelf Financial Group, but it's going to say PeerShelf Financial Group of Apollon. We're still using Schwab, but it is giving us some exciting additional tools we didn't have before to help us with more complicated financial planning. They're going to take some back office stuff off our plate that I'm going, hallelujah, so I can spend more time doing more webinars like this one. And by the way, we've right now got about 95% of the families. We've taken care of the paperwork. So if our cell signal goes negative, we're going to be able to get you out. We have some of you, I think I have maybe a couple on this webinar tonight. You haven't, signed the updated paperwork. Please, please, please do that, because in just a few days, we're not going to be able to make changes in your account if one of our signals goes off, okay? And so do me a favor and get that in, okay? All right. And folks, I'm going to look forward, we do have reviews set up coming up in the next few months, and I'll look forward, to talking to some of you when you come in for those meetings, okay? So with that, I think I'm done, and I'll just say God bless you and good night.